Hello and welcome to another episode of The Pitch, brought to you by Livewire Markets. I'm Hansley, and joining me today is Gopi Karunakaran, the Co-Chief Investment Officer at Ardea Investment Management. Gopi, we thought we'd take a look at two common holdings, or if you like, two common perspectives to most fixed income funds, and that's duration and credit. Let's start with duration. You and your team run a duration neutral strategy.
That's right.
Now, what does that actually mean, and why does it matter?
Sure. So quick refresher on the concept of duration and why it's relevant for fixed income. So duration is a measure of your sensitivity to interest rate fluctuations, to put it simply. So in simple terms, if you buy a government bond, let's say a 10-year government bond, and interest rates were to go up, or the market pricing of interest rates were to go up, the price of that bond would go down. And so you're going to have a performance impact associated with that. A duration neutral portfolio, like the ones that we run, do not have that exposure. So our portfolios are indifferent to whether rates are going up, down, sideways, it doesn't matter. So that's what duration neutral means.
With that said then, do you think the best days for short duration government bonds are behind them? Because I think all throughout this rate hiking cycle, we've seen the most volatility, but also the most profit being generated, or most price appreciation being generated in short duration government bonds.
Yeah.
Do you suspect those best days are behind them?
Look, I think it depends on what you're using them for.
Okay.
So, if you look at short duration, well, whether it's government bonds or corporate bonds, you look at short duration bonds in general, they're offering a pretty decent yield these days because rates have gone up. So, 4 or 5%, depending on which market you look at. If you're focused on income, that can be quite useful, can be quite helpful. Now, other reasons why you have fixed income in your portfolio would be to diversify equity risks, right? The equity risk is the most dominant risk in most portfolios. And if you think about that traditional 60-40 portfolio construct, fixed income can help you diversify that equity risk. That's where it gets a little bit tricky because what you're relying on there when you want to diversify equity risk, say in a recession scenario, is your duration. That's the thing that's going to help you because what happens in a recession scenario is rates go down typically, central banks cut rates, bond prices go up. If you're in that short duration segment, you're not going to get that duration component. You're going to get the income, but you're not going to get that duration. Now, typically what you also find in the short duration component is there tends to be a lot of credit risk in there because to get those yields without the duration, you have to sort of layer in a bit of credit risk. And that can become a bit of a tricky situation as well because we know that in an equity down market, credit can do badly as well. So it really comes down to what are you using this for? And I think it's important to be clear about that from an investor perspective.
And just to clarify, that credit risk, how does it show up? Does it show up in the premium that you pay for a bond? Or
yeah, so what typically happens, you have this idea called of a credit spread. So this idea that if you're buying a corporate bond, it gives you a higher yield than an equivalent government bond. And that difference is the spread. Now that spread is compensation for risk. It's not free money, it's compensation for risk. So what typically happens is when you go into a stressed environment where equities are down a lot, that spread tends to increase. So that means corporate bond yields go up, but there's an inverse relationship, prices go down, and so you're going to have a negative performance impact. And at the tail, you've got default risk. So that's the risk that a company gets into trouble and defaults. Rare, but painful if it happens.
And so that risk then, and I just heard you say defaults there, because I do know that both of the major Ardea funds don't have credit investments in them. Is that why you don't want to play in credit markets specifically?
Yeah, well, there's a few reasons for that, why we don't. So you're right, that's correct. None of our portfolios have any corporate or credit type securities in them. So why is that? The first one is liquidity. Our investment style requires high turnover, lots of trading. And so you need liquidity, and you need reliable liquidity, you need low transaction costs. That is a feature of interest rate markets, reliable liquidity, low transaction costs. It's not really a feature of credit markets. Transaction costs are higher and liquidity can be patchy in stress times. So that's one, is liquidity. The other one is correlation to equity risk. So we know very well that in a stress scenario when equities are down a lot, so think about COVID, when COVID hit early 2020, credit's going to do badly. We are trying to offer a diversifier, a defensive diversifier to clients. So if we had a lot of that credit risk that's going to behave the same as equities, that does compromise a bit of the benefit that you're getting from defensive diversification.
Sure, got it. But so that's that. But also, credit spreads are often seen as an indicator of corporate health. I know you don't play in the corporate bond space specifically, but I guess do you have a view on the outlook of them, and do you have a view on whether we're in a widening era or a tightening era, if you like?
Sure. So you're right, I'm not close enough to have a view on where they're going from here, but what we can see very clearly, and what we pay a lot of attention to when we're thinking about risks and tail risk, is what's the consensus saying? What's actually priced in to markets? And what we can see pretty clearly when we look at credit spreads is a pretty optimistic Goldilocks type of outlook that's getting priced in. And a very easy way to see that is if you have a look at the spread history of something like a global high yield bond index and look at how it's tracked over time, you can see that where we are today is very much towards the lows, the low end of historical ranges. What that's telling you is markets are not particularly worried at the moment about recession or anything like that, and therefore the spread being low means markets are not willing to pay a lot of risk compensation for that. So you could call it optimism, you could call it complacency, I'm not sure which one, but that's what we see.
Well, if we've learned anything in the last 4 years in markets, it's not to be complacent, or you can't afford to be complacent. Gopi, Karunakaran, thank you for joining us from Ardea Investment Management, and thank you for joining us. If you enjoyed that episode of The Pitch, do subscribe to the Livewire Market Index websites as well as our YouTube channel. We thank you for watching.